Government drama llama ding dong talking about stock market stuffy stuff. That's right, today we're going to discuss the stock market crash that everyone's well aware of, the 1987 stock market crash, also called Black Monday. There was a lot going on in the 80s, but to put events into perspective, in the early 80s the United States was going through a recession. In 1986, the company Enron was created after a merger. To be fair, as far as I'm aware, Enron was not part of the whole stock market crash on Black Monday. I just felt I wanted to put this in. 1986 was also the year that there was a little problem with a nuclear reactor at Chernobyl. In 1987, Brazil has its own incident with radioactive contamination. All of that has occurred or is going on, and in February of 1987, Wall Street professional Martin Siegel pleaded guilty to tax and securities law violations relative to a lucrative insider trading scheme. Through his insider trading scheme, he had netted $700,000 over 4 years of providing stock tips to high-powered arbitrator Ivan Best. I don't know how to say that. As far as the overall cause, there doesn't really seem to be a clear consensus. There are a couple theories that people tend to lean on more so than others, but I'll just go through some of the main ones that I found. By August of 1987, there were already concerns about an asset bubble in Wall Street. This is not the first or last time that there was considered an asset bubble. There was the dot-com bubble. Later, they had the mortgage crisis where, to really oversimplify, essentially the stock market price is going up very fast, but the actual value is not, kind of like, the AI thing. Along with overvalued stocks, another theory as to what could have affected this is the Louvre Accord in February 1987. The US dollar was starting to depreciate since 1985, so this was an attempt to stabilize the currency market. There was a bunch of stuff that led up to this taking place, such as trade deficits and things like that, but for now we're just going to leave it at that. We also can't forget the political events that were happening at this time. On October 14th, 5 days before Black Monday, there was a bill put forth to reduce tax benefits associated with financing mergers and leveraging buyouts, and this would basically reduce the benefits that come from that. The Department of Commerce had made an announcement about the high trade deficit, the interest rates were going up, stock prices were going down, and by that Friday, stock prices were already starting to take a dip. With all of this going on, a lot of people were nervous and they started reacting on gut feelings and reacting to things immediately. That big blip down in the graph above me is Black Monday. When the market opened, the Dow was at 2,246.74 a share, and by the end of the day, it was closed at 1,734.74. The last time a dip this large occurred was 1929. Even though computers started to be used as part of the stock exchange, there was still a lot that was still being done the old way. Because everyone was nervous about the market and everything going on, when the market opened, there was way more orders to sell than there were to buy. This combined with the fact, this also meant that the computers that were in place got overloaded on the number of orders. There were glitches, there were some orders that weren't fulfilled, or if they were, it was hours later, not to mention the computers that would end up getting shut down at the same time. And by the end of it, it was estimated that over $500 billion was lost. This didn't just affect the US, this affected international markets. So in some places it's called Black Tuesday instead of Black Monday because of time changes and all that kind of thing. The question then becomes, how do we handle this? On October 20th, 1987, Federal Chairman Alan Greenspan said the Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Basically, they became the lender of last resort. Some have argued that the Fed's response to Black Monday ushered in a new era of investor confidence and the central bank's ability to calm severe market downturns. Unlike many prior financial crises, the sharp losses stemming from Black Monday were not followed by an economic recession or a banking crisis. On the other hand, some argue that the Fed's response set a precedent that had the potential to exacerbate moral hazard. And by the end of all this, the stock market quickly recovered a majority of the Black Monday losses. In just 2 trading sessions, the Dow Jones gained back 280 points, or 57% of the total Black Monday downturn. Less than 2 years later, U.S. stock markets surpassed their pre-crash heights. This isn't to say that there weren't casualties, but it definitely wasn't the same as the 1929 crash. There are also aspects of the 1987 market crash that led to what happened in the 2008 recession. At first glance, the convulsions in the market in 1987 bear little resemblance to the financial problems we face today. The 1987 crash was not the result of a financial crisis, nor did it lead to a prolonged recession. Look more deeply at the causes and repercussions of the crash, however, and you may find that rhyme with those of the 2008 crisis. One aspect of it is that there were new and untested financial instruments deployed in the market by computer programs. It also affected international markets, and not to mention the fact that Alan Greenspan taking over the Federal Reserve and his attitude toward the crisis greatly influenced the 2008 panic. Regarding the 1987 crash, there were two triggers according to Geist. In addition to an overvalued market and deteriorating macroeconomic environment that led to an international market break on October 17th, and then a more than 20% decline in the S&P 500 a couple days later on the 19th. One was the rumor of imminent interest rate hikes in defense of the dollar by the new Fed chairman Alan Greenspan. The market had experienced very high interest rates between 1980 and 84 and was spooked by talk of a return to those rates. Another cause was legislation filed by the House Ways and Means Committee that would have eliminated tax breaks on debt used for mergers and acquisitions. Tax laws figures very prominently in valuations of companies, and this caused investors to reconsider the value of their holdings. All panics are essentially made of the same stuff. No matter how much the street changes, there will always be a tug of war between overconfident traders armed with new hedging mechanisms and the regulators tasked with keeping them in check. Increasingly, humans will struggle with how to deploy computers to make markets more efficient without having those computers hijack the process, and central banks will walk a tightrope between protecting the public from economic calamity and distorting natural market mechanisms. We've been on this merry-go-round before. About time we learned from it.